The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hello and welcome back to Ausbiz live from our Barangaroo studios. You are tuning in to The Call. 10 stocks picked by you. I put them to two experts in 1 hour. It is Thursday, the 3rd of November, ladies and gentlemen. And finally, it is showdown time, or should that be show time? Now for the main event here at The Call on this Thursday, the heavyweight bout in the blue corner, the man with the suave, dapper looks from Shaw and Partners, Philip the Bull Pepe. And in the red corner, the smiling assassin from Deep Data Analytics, Mathan the Bear Somasundaram. You two, keep it clean, keep it competitive, keep it concise, but give us good direction. Philip, you came up with this. How on earth did you come up with this poster?
Well, it's actually done by a wife of one of our former colleagues, Christy Shanahan. So Mathan and I used to work together. And I think when I met him about 8 years ago.
Was that a good experience?
It was a great experience.
Right.
I learnt a lot. We used to spar a lot, metaphorically. I think
right.
When I met Mathan, he said, "Hi, I'm Mathan, the market's overvalued." And I said,
and he has never changed.
I think you're wrong. And every research report I wrote that had to buy, he said, "You're wrong, and this is why." So that's fine. He's more quantity in nature. I'm more fundamental. So every morning meeting was interesting. Yeah, and I've been watching Mathan on Ausbiz for quite a while. And when I finally got on the show with Mathan, I sent our colleagues, ex-colleagues, "Hey, I'm finally up against Mathan." So Christy put this poster together. So, and the money's on Mathan, by the way. So,
don't you start the psychology. He's starting the psychology already, Mathan, isn't he? Was he always like this? Was he all, all suave and dapper, but quick with the uppercut?
Never trust an Italian, especially a Pepe. Nah, he's good. Look, he comes from, as he said, he's a bottom-up analyst. I'm a top-down macro guy. When you meet, there's always going to be discrepancies, and that's the beauty of investing.
Do you ever meet in the middle?
Oh, look, I think we meet a lot. I think when it gets to the interesting part,
when the market's closed,
where we are different, I think that's the interesting part. And it's, you learn from analysts on how they look at things. And when you're coming from a data side, you look at it completely different. So the discrepancy between the two cycles, I think that's the real value add in the process. All
right. Okay. Well, we've got 11 rounds today. And for the first 5 rounds, we're going to be talking, our stock of the day is going to be New Hope. This half hour, we're going to also cover Premier Investments. Talga Group, which I had never heard of, but quite an interesting investment group. Duratec, Retail Food Group, iShares, Core MSCI, WorldxAus Australia ESG Leaders is the ETF that we're going to finish on. But first of all, stock of the day that I chose for the two fellas today, coal miner New Hope Corporation will buy $300 million worth of shares back within the next 12 months, following on what Whitehaven has done. New Hope says the board has approved the share buyback after taking into account future expected operating cash flow requirements. The buyback will commence November 17, likely to be completed within 12 months, subject to prevailing share price and market conditions. It follows full year revenue lifting 143%, $2.6 billion. Net profit soaring after tax to $983 million. Let's see how the stock's performing today. One of the few stocks that is actually up at this stage. Mathan, number one, what do you think of the buyback? Because Whitehaven has been criticised for its buyback at these elevated levels. Why not buy back at lower levels? Their counter is it's capital management, give it back to shareholders rather than invest in something different and take the chance of that. And the stock price at the moment, what do you reckon?
Yeah, look, we've talked about call before. Give credit to Gaurav when he's not here, so let's do that. So he picked it early. It's an energy thematic. You are picking on everything in energy is doing well. And coal was one of the best performers. And you're seeing a bit of a pullback in that, and the others are recovering. So I think the thematic still holds, and coal's been doing well on the back of that. And I think it makes sense. I don't think anybody's going to be surprised by that. It was expected. And the whole talk about why won't you wait till things collapse? So the reality is, when share price is really cheap, management is getting hit on the fact that it's cheap. Why don't you do something about it? And so when it's expensive, don't do buybacks. When it's cheap, they would want people to spend money and try and redo the business. So in reality, no matter when they do buybacks, they're always going to be questioned on it. So I don't think that matters too much. Now, all they're doing is they're increasing the share count, makes the growth outlook for the next year a bit easier. They're churning out cash. They're like better than the banks at the moment. And you make hay while the sun shines. And right now, the energy sector is doing as well as they've done for a long time. So I don't have a problem with it. But look, if you're holding it, great. I think it's still doing well, still churning out cash, and the buyback will support the share price. But if you've got fresh money, I think you're coming late to the game in coal. But there are other energy sectors still looking quite interesting. I think in the speculative end, you've got uranium. I think the oil price starting to climb. OPEC is looking at demand and saying they might have to move again on cutting supply. There's geopolitics playing out on the supply side. So oil price is looking strong, and I think it'll recover, and that'll play well for the whole energy sector. I don't think that's great for the economy, but overall for the sector as an investment thematic, holds up quite well.
Philip, what do you think? Firstly, of the buyback. Even Mathan, for a number of times, says the problem with big resource stocks is when they're making too much money, they go and buy something and bugger it all up because they usually pay too much. Here's a resource stock that is saying, no, we're not going to muck around with the business. We're going to give it back to you as shareholders.
I think that makes sense, and I think it's a buy.
Right.
So coal companies are doing very well at the moment. The met coal price was $50 US a tonne a few years ago, about $350 a tonne today, having come off $450 a tonne highs, double on PCP. New Hope made about $1 billion in free cash flow last year. In different times, they would invest that in new mines and trying to expand coal production. You can't do that at the moment. No. It's politically incorrect. So what are they doing? They're giving it back to shareholders. So that's 20% of its market cap in free cash flow that they paid a special divvy with the full year, and they're doing a share buyback. I think they said in the release they think it's cheap, but with all this cash, rather than sitting there earning zero or next to zero, they can't reinvest it. Give it back to shareholders. If you've got franking credits, pay the special dividend. If you don't, do a share buyback.
And the other thing they could do is, let's diversify out of coal. Well, that's fraught with danger, isn't it?
Investors can do that better than they can. So look, it makes absolute sense. Why I think it's a buy. As Mathan said, the buyback will support the share price. They're probably going to have another strong year next year. If coal prices stay anywhere near where they are, even if they come off a bit, there's still several $100 millions in free cash flow. You might get another one next year or another special divvy. So it's stronger for longer, I think.
Okay, so you don't reckon we've missed the boat on this?
No.
For investors to get in with new money?
Not at the moment.
Okay,
no.
All right, buy on New Hope. All right, let's get into the stocks that you want us to take a look at. And first up today, Sam wants a view, Philip, on Premier Investments, Solomon Lew's Retail Empire. Any parent or grandparent knows you get fleeced at Smiggle. Well, they own Smiggle. By owning these shares, you could at least get your own back. Peter Alexander, a whole bunch of different famous retail brands. Their investment side, they own stake in Breville and, of course, a long-term investor in Myer.
Yeah. Look, I think it's a buy. Very high-quality retailer. Everyone's waiting for the consumer to fall over, for retail sales to fall. It hasn't happened. The print a couple of days ago showed that clothing sales are holding up, general retail is holding up, and we've seen JB Hi-Fi and Supercheap all put out good results. And Premier on Friday, after guiding to strong first 7 weeks of the year, gave an update saying the first 12 weeks are up 40% on PCP. They're doing very well. The full year results surprised on the upside. Analysts were forced to upgrade. Share price moved 15% on the day. That was the extent of the surprise. why he's a very good retailer, or they are very good retailers, manages the costs quite tightly. They got some high margin brands in Smiggle and Peter Alexander. Peter Alexander, the pajama brand, keeps going from strength to strength. Yep. They could take that offshore at some stage if they want to. Smiggle is recovering. It's a back to school category. Other side of the world's going back to school now. Those sales have gone up strongly. They paid a special dividend, also announced a share buyback. So for me, it's a company that keeps performing. Analysts keep waiting for earnings to decline. I think consensus has got FY23 declining. If what they've stated were the first 12 weeks of the year continues, you're looking at analyst upgrades into FY23, right. 1.5 billion in cash investments, property, etc.
Okay, so are you bullish on the whole retail sector or just selected ones? Because a lot of people say, hey, headed into recession, consumers going to find it tough, but they've all the retailers have been smashed, haven't they? Except for Lovisa, which has got to get the trend.
Good companies don't sit there and let things happen to them. So Premier has 70% of its leases in holdover, so they can close down underperforming stores if they need to. About 22-24% of their sales are online. So if they've got an unprofitable store or it's not working, they can shut that down. They can manage costs pretty well. So they're not going to just sit there and do nothing. So for me, when you get a quality retailer being sold off, from a long-term perspective, it's a chance to buy stocks at a depressed value where the outlook isn't as bad as consensus.
So PEs are still low for Premier?
EV to EBIT's about 7 times. PE's about 12, 14 times. But you got to strip out Breville and Myer and the cash and the properties and that kind of stuff. So for me, it's compelling value at this level.
Mathan?
Yeah, I was wondering what Pepe was going to say about Premier. He's been good picking this. He's picked the top and the bottom quite a bit, so I'll give him credit on this. So in that context,
gee, the tone of your voice wasn't that conciliatory. I know the words were, but the tone behind it, Philip.
There's a but coming.
Yeah. Right, yeah.
There's a but. Yeah.
All right.
There's a but coming.
Yeah.
Every analyst spends their whole life looking at a sector and they fall in love with it. So you just got to be careful. And don't worry, I tell Pepe this every time. Premier is a really Pepe's right. I mean, it's really well-run business. Management is really good. And funnily enough, my daughter works at Smiggles, and the amount of money that gets through that place is amazing. Even in a tough economy, kids are kids. Parents don't have a choice. So in that context, it's doing well. And I think the stores will hold up relatively well. But the reality is the economy will slow down, but it hasn't. Everyone is just adding to their debt. People are just borrowing more money and spending. I mean, this is the reason why the Fed last night came out hard, because the biggest problem globally is everyone thinks that there's a bailout coming. So everyone thinks, okay, I'll just borrow more money. And they've added more debt to the existing eye-watering debt to keep things going. So high inflation is not having an effect yet because people are just borrowing more and more money. And unfortunately, it just forces the central bank hands, and they're going to keep raising rates. And so eventually it'll crack. So, I think you've got to be really careful in the retail sector. You want to pick the guys who can manage the cycle. These guys they're in the top tier, and the multiple is actually not too bad. I think we have this in the investment portfolio from memory, and I think it holds up better than most. And in that context, I'm happy to buy. In this kind of a tough macro, retail sector has been bashed up and it's recovering. So I think net, I think it's placed well. So if you're looking for retail exposure, this one stacks up.
Round 1, and we have an agreement there.
Wow.
Between the bull and the bear.
I know. I was hoping to have a bash, but
there you go.
But Mathan, just on your point, because it's not the same here in Australia. We've still got really high savings levels. But I saw a chart from Bloomberg yesterday and Lombard Odier. Credit card loans are at 33% of disposable income in the US, and savings are now down to 3%. During the pandemic, they were at 23%. Now they're 3%. So that backs up what I was stunned when I saw that chart yesterday, how much it's changed, to back up your argument that they're just borrowing in the US until the cows come home.
Yeah, because people are telling people that, they'll get bailed out. It's like the I mean, the insanity that was pre-GFC,
Right.
it's coming through now to the point where people are saying, well, if we all get into trouble, then they have to bail us out.
Yeah.
And that's where Jerome Powell last night came and said, people, stop doing this because you're making my job even harder. Because he wants people to stop buying too much so that things will slow down, inflation comes off, and they can take the foot off the pedal. Now they're being forced to. And look, RBA can deny the facts, but the reality is the pressure will build gradually in Australia as well. And then RBA may have to pivot to higher hikes.
Okay.
So they don't want to do that. You know, they're pro-property, so they don't want to do that. But the reality is...
But Australian households seem to be in much better shape than the US.
Yeah, look, I don't think we're facing the recession risk, where in the US, I think the odds are pretty high. Like we're talking 80, 90%.
Almost certainty. Yeah. All right, let's move on to our second stock. Peter wants a view, Philip, on Talga Group, a technology minerals group, graphite exploration in Sweden, and also in Germany and the United Kingdom. What do you think of Talga Group?
Yeah, look, I had to do a bit of research on this one.
Hadn't come up before, I don't think.
Yeah, look, it's in the battery technology space. It is a cash burner, so normally I would say avoid. But they recently did a capital raise. I think they raised about 22 million, and they've signed a non-binding offtake agreement with a large European car manufacturer. So it's probably safe for the next 12 months, and it's trading above the recent capital raise price. So
that's a good sign.
That's a good sign. So I would hold on. I wouldn't buy any more.
Right.
But given that they've got an agreement in place, they've recently raised money, they're secure cash flow for at least the next 12 months. For me, it's a hold. I'd hold on to see how it goes. And that's not a terrible chart. I wouldn't put any more money in. But if you invested a couple of months ago, I would hang on to see how the next 12 months plays out.
Mathan, graphite, and batteries. Gee, they're buzzwords at the moment, aren't they?
Yeah. Pepe spoke like a perfect broker.
Is that an
Into
insult?
the cap raising. I love it. I love Pepe. In that context, look, everyone knows the energy sector is hot, and the battery commodity technology side of things, it's the hot of the hot. Yep. So if you haven't done well in the last 12 to 18 months, there's something wrong. So if your stock price is going sideways or downwards in this thematic, when are you going to do well? Because just have a look at lithium, just have a look at graphite stocks, just have a look at anything, uranium, everything linked to any kind of energy resource has had a huge run. So this has gone sideways for the last 2 years. And I don't think the market completely buying into it. So you need to trust management to deliver something better than what they have done in the last couple of years in an environment with rising costs. Maybe not. I think the risk return is not there for me. This is probably been there. It could work out, but at the moment, what I'm seeing through the share price, what they've done, the deals that they've announced, it's just not getting the reaction from the market. The market's not buying in. And so when you look at other comparable thematics in that sector, they've all done really well and they're coming off their peak. This hasn't even had the run. So I think when they roll over, this will roll over as well. So for me, you've got to be looking at thematics that are improving, where the market is starting to look at a thematic, not the thematic that everyone's already in and you haven't done that well to start with. So if you've been there, unfortunately, you haven't done well. You just got to move on, because hanging on to something that's not doing well, the market's not buying into, the thematic is not getting the traction, it's a loss-making company burning cash. Yes, they've raised money, and we know some of these companies that burn money can keep burning money for a lot longer than what you think.
So sell for you.
Yeah.
Okay. All right. Liam wants a view, Mathan, on Duratec. Now, it's a specialist contractor in protection, remediation, refurbishment, particularly in steel and concrete infrastructure. This reminded me of a sort of infrastructure, bigger version of Johns Lyng, is it?
Yeah, it's interesting. Oh, look, this is the beauty of the show. I've no idea about this stock, heard about it. I had to run through the numbers, have a look, what's doing and so forth. Look, it looks interesting, but the cost pressures is a worry. Even the good guys are getting hit. So this is definitely a risky area. It's 100 mil market cap. So you're playing in the micro cap space, just where we are in the market cycle. Small caps, micro caps outperform small caps. Now they're underperforming. For the first time, micro caps and small caps are underperforming large caps. So the cycle has turned around. So you're in a high risk area. Liquidity is a huge issue. If the market panics, you just need one decent seller to want to get out and the share price gets absolutely pumped. So that's the risk return. So now is probably not the time to jump into a micro cap. But this has got interesting thematics. I mean, it's a unique type business. It looks interesting. I think it's one you want to keep on your shopping list. I'm not looking at $100 million stocks in the current market cycle. I think you want to look at them probably late December or early January. Right now, it's a bit risky for micro caps. And so this is not there for me at the moment, but it's definitely a new stock that I've learned about and it's on my shopping list.
Okay. Philip?
So Mathan's ignoring the fundamentals as usual. So I think the stock is a buy. It's in a space where there's a lot of spending happening at the moment. They're repairing aging infrastructure, water, defence, all that kind of stuff. So that spending doesn't go away because there's an interest rate rise or there's a war on the other side of the world. Their work in hand or their order book, last reported was $458 million, more than double on the prior corresponding period. Their tenders and pipeline is $2.4 billion. So as Mathan pointed out, 100 mil market cap company tendering on over $2 billion worth of work. There are cost pressures, there's labour shortages. So contractors like Duratec are saying to their clients, this is the price, and this is the price for this week. On Monday, there's a new price. So ultimately, the governments, the large infrastructure builders, need the work done and they're paying the price because otherwise the work doesn't get done. So if a bridge breaks, you need to fix the bridge.
So they are like a Johns Ling, which is in retail, remediation and repair, but they're in the big government infrastructure areas like bridges and roads and other big industrial.
And there's a lot of spending in that space at the moment. And there are a number of players that do it, but for want of a better phrase, their books are full. So they're not discounting like they used to in the past to win some work. Their margins are holding up because there's not enough labour. So we actually like the space, and this company, as per the share price, has been doing well. And as long as they win their fair share of those tenders, that share price should track upwards with their earnings. So we like it. I think it's a buy.
Not too small, illiquid?
They're certainly bigger. It's not for everyone. Liquidity is a risk, but liquidity is probably factored into the share price as well. So not for the mega funds. You can't get set in a stock this small, but for the average personal investor, you should be able to pick up a few to have a meaningful position.
Right. Okay. All right. And next stock is Philip, is Retail Food Group, of course. Operates a number of franchises and big brand names, Donut King, Michelle's Patisserie, Brumby's Bakeries, Gloria Jean's Coffee, Crust Gourmet Pizza, all under the one umbrella. What do you think of Retail Food Group, particularly after Domino's warning came out?
Yeah, I mean, Domino's is more of a global company. This is Australian focused. If you look at their share price has really been hit in the last 2 years. It was impacted by COVID. So we think it's a buy. We like the story. Right. Main reason is it's a COVID rebound story. So a lot of their stores are in shopping centres and people just didn't go to shopping centres during lockdown. We've heard from other retailers that people just went to the supermarket, bought what they needed to, maybe the pharmacy, went back home. So foot traffic was down. That's now starting to normalise. People are also coming back to the CBDs, so they're getting foot traffic back through the stores, the various stores, and we expect their earnings to grow. We also think what they sell is relatively defensive in a downturn. If you're going back to the shopping centres over Christmas, you're probably going to buy your kid or yourself a donut, you're going to buy a cup of coffee, you might buy a pastry at Michelle's Patisserie. So quite defensible earnings as people trade down. You heard from the retailers
last week. Chart... It's a weird looking chart, isn't it? It
is. It's not the most liquid stock, so you need to be aware. But you can see, pre-COVID, it was up sort of 7 cents. It dropped to 4.5. It's now back up at 6. We think it's worth a little more. As they start, there is an ACCC issue that they're working through with some of their franchisees. That seems to be coming to an end. So as they work through that, and as we start to see actual data points, maybe the first half result where people coming back into their stores, their earnings should go and their earnings should be relatively defensive in an economic downturn because they sell donuts, coffee, pizza. Not expensive.
So you have it as a buy? Okay. Mathan, what do you think of Retail Food Group?
Wow, this one has had amazing history. You have to give it that. I've been looking at this for, I think, a good part of a decade. They were massive story, probably, I think it's traded like $5-6.
Yes.
And they were selling, the whole theory was at that time that they had this huge franchise business. They, expanded into different areas, and a lot of them sold coffee. Then they made their own coffee, and the deal was that you had to buy their coffee in each of those stores. So the more they buy under the umbrella, the more they sold. That's a high margin business. It was a great business model, and it was killing it till it didn't. And then when it didn't, it's amazing thing about when a stock goes into an upgrade cycle, runs the cycle, and then when it turns and it gets into a downgrade cycle, it just downgrades to the
because that if we can bring up that 5-year chart again, sort of 5 years ago, it was back at $5. How come it's at 6 cents now?
Yeah, it's basically gone from one of the market darlings to something that nobody wants to touch.
No.
And it's amazing how that has turned around. This used to put out numbers. Yeah, it's got a great brands, and Phil's right. You reopen cycle, people coming in, the crowds, it should do better. But I think, if you talk this to any fund manager, they will turn around and run the other way, because pretty much everyone's lost money on this over the years. So it's a tough one for most people. But look, I suppose that's the advantage for a retail investor. I think its management track record will be, in the negative scores. So that's the problem. But geez, they got great brands. They're spread everywhere, and the recovery's returning to the I suppose normality should drive better earnings. So they should do better. But look, it's a micro cap. It's high risk, and management has low this thing. So this is one way.
Philip's eyes are sparkling here. He thinks you're on the verge of an agreement.
This is this is a high risk, ugly buy, and it's ugly. It's nowhere. No matter how you put a lipstick on this pig, it's still a pig. So this is ugly, but it is so ugly that you have to look at it, because it used to be a market darling. It should do a lot better than what it's been doing, and I think risk return is in your favor. I think you should take a bet on it, but I wouldn't put a lot. I'd put a little bit and see how it runs.
Okay, all right. It's an ugly buy. It's been beaten up, but coming out for the next round maybe. All right, Philip, our next stock, ETF, the iShares Core MSCI World and Australia ESG Leaders ETF. Anyone with an ESG filter, what does this look like?
It's an interesting one because you're playing the market, and I think it's hedged. So days like today, you sort of think, why would you look at it? For the genuine long-term investor, I think it's a buy. It's a good way to access the market, lower fees. So you're not paying funds management fee. It's basically a passive fund. I think it's at 2-year lows or something, something of those sorts of levels.
Yep.
Generally speaking, over the longer term, share markets go up. Obviously, last year or two, they have not. If you're taking a genuine 3 to 5 year view, this is a great way to enter the world equity market. Don't look at the share price daily. Days like today, it's going to be volatile. But I actually think it's a long-term buy, particularly days like today or years like we've had where it just gets thrown out. Longer term, this should trade higher with general equity market.
So for retail investors who go, look, I want a bit of an ESG sort of flavour, is this the way to do it rather than individual stocks?
It depends on your skill set, depends on your time and whatever else you own. So I work for a financial advisory firm. Speak to your advisor, find out is this the best for you, because you're talking about one investment in one equity market. So how much should you put in the equity market, let alone particularly ESG things. So sometimes you might want an aspect of ESG, you might want a handful of funds. I wouldn't make this my only stock. It needs to be part of a broader portfolio. So
part
it is
of
one way to access. It's probably not the best way to access it. But if you're time poor, you don't want to do the analysis, buy an index fund.
All right, Mathan?
Yeah, ESG. By definition, it's got something working against it because if you look at why ESG did so well for a number of years, is mainly because of what most markets enjoyed, which is lower rates falling even lower and multiples expanding. So by definition, ESG does not invest in things like mining. And so those kind of things works well when you got multiple expansion hitting all the tech stocks, because they were predominantly playing the tech sector. So ESG by definition will be a growth play. So the problem here is where you are in the macro cycle. So when interest rates go up, growth stocks have multiple reduction, they run into growth issues, they get hit on earnings, so they get double dip. So that's why they get hammered. So we actually run a ESG ETF model, and we manage it through with bear ETFs to manage risk, and that's been going up while the actual universe has been underperforming. So it's not that ESG fund managers are bad, it's just that the universe they're picking from is actually just in free fall. So it doesn't matter what you pick, you're going to be falling. So you're picking an ESG, you're pretty much betting that interest rates have to start falling. That's right. Pretty much it, because otherwise growth stocks struggle and ESG struggle. So if you're looking at it as an investment strategy and you want to have that over the long term, I wouldn't pick ESG in the current macro. I'd probably go the overall market ETF. Yeah. Because in a rising, I think interest rates will remain elevated over the next decade. Right. And I think the market will see that US is probably going to go 5% or even higher. Right. So in that kind of environment, I think ESG continues to struggle, not because of the ESG concept, it's just that the universe that they go for are predominantly growth stocks, where if you put in the overall market, you get the mining resource play that gives you that leverage to the inflation, and that kind of balances it out. So, and also this one is ex-Australia, like the only market that has a decent amount of resource exposure is Australia. So, you're kind of shooting yourself twice. So I think you're better off buying a global market ETF rather than a specific one. And I think you need to have risk management. So you need advice if you're going to be using this one. You need to understand how to manage risk. But otherwise, I think some of the ETFs, when you go into these selective categories, it can work against you.
Okay. All right, let's recap the first 5 stocks and stock of the day. New Hope, a buy from the bull, a hold from the bear. Premier Investments, the bull and the bear agree on this. It is a buy. Talga, the bear has a hold. Mathan, the bull has a hold in Philip. Mathan has a sell on it. Duratec, a buy from Philip. Mathan has put it on his watch list, didn't know much about it. Retail food, the bull and the bear actually agree on this one. Mathan had to put his own spin on it, saying it's an ugly buy. That's the concession, because he doesn't want to agree with Philip too much. And iShares World Australia ETF, a buy from Philip if you want that sort of filter, but not have that as the only thing in your portfolio, and a no from Mathan. Here on the call, we're tracking our own high conviction growth fantasy fund as picked by the investment committee, which Mathan is on. You can watch the latest investment committee meeting on ausbiz.com. Give an update from that meeting. The portfolio had Incitec Pivot removed, 7 Group Holdings had its percentage added to, and Mineral Resources was trimmed. JB Hi-Fi and Wesfarmers also had their weightings increased as well since the 1st of March. The fund is up, fantasy fund up 6.5%. Of course, keep sending in all of your requests here for the call. That's the first filter up to the investment committee.
The Last Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit and ready-to-drink cocktail brands.
Yep, join us tomorrow afternoon for the last call as we wrap up the week. This half hour, we're going to run the ruler over Ansell ASX Touch Ventures, which is an interesting one, Viva Leisure and Elders. Philip, what do you think of Ansell, the protective glove healthcare manufacturer?
It's an interesting one. Mixed results recently. They had some production issues given COVID, lockdown and stuff, but demand for their products clearly are going up with extra personal protective equipment in demand given the new world, and with surgeries returning to normal, you'd think demand for gloves and stuff will increase. But input costs are also increasing as well, and they're probably increasing at a faster rate than actually demand is. So there's a little bit of pressure on margins, and I think they've got a relatively cautious outlook statement as well. The Euro-US is also moving against them. It seems to be trading in line with analysts' average valuation, so it's not particularly cheap, but it's not expensive. So if you owned it, it's probably in a good space. It looks to me to be fair value. So they've been pretty open with their outlook. So there's no reason to rush out and sell it. But I wouldn't buy it at these levels. So for me, it's a hold. If you found something cheaper to buy, recycle into that. But for me, on valuation, it's a hold at best.
Okay, Mathan, 45% of revenue from North America, a third from Europe, Middle East and Africa, 14% across Asia, 8% in Latin America. They've got sort of tentacles everywhere, haven't they?
Yeah, I mean, they used to have, lifestyle condom business, which they sold out. And they're basically a play on global manufacturing, health and safety play. So they tend to do well in a recovering manufacturing cycle. And right now, we are in a weak manufacturing cycle. I think management is great. I think the track record is amazing. In a tough macro, these are the kind of guys you want to back for a global business. They've got enough spread around the world that they will benefit off the recovery cycle that'll eventually come. I think Phil's right. I think the short term, the cost pressures will hit them, the currency issues will hit them, and that's what's priced in. But I think the management is good enough to manage through that. And the reality is the cost pressure that they actually put onto their customer base is very little. So the safety aspect of what they provide, I don't think their customer base is suddenly going to say, oh, I'm going to go to a cheaper one, because the risk return if something goes wrong is so high. And because it's such a small part of their cost base, it's not going to matter too much. And I think most people understand the fact that there's inflation and cost pressures are coming through. So I think they're okay. They'll put up prices, but it's going to be a tough cycle over the next 6 to 12 months. But I think they recover from that. I think the market's aware of that. So I don't think you're going to be shocked by any, tough outlook. But look, I like it. We like it. It's run up. Valuation is not cheap, but it's not expensive either. I think it holds up well. It's a bit like Premier. Because they're big, good, and have a great track record with management, I think they'll hold up better. So these are the kind of businesses you want to back in a tough macro. So I'm happy to buy, I would say probably you buy on weakness, but if you have it, it's a definite hold. But it's a strong business. I think it'll be there when manufacturing recovers.
So you're a buy?
Yeah, I'll go for a buy.
Okay, so the bear's going to buy. Philip, are you surprised at that?
Yeah, I would have picked it as a sell for you, Mathan, but that's okay.
Okay, see, maybe spending a bit of time with you, Phil, after all these years, starting to rub off a bit, in half an hour.
I tried.
Okay. All right, Mathan.
There's only so much sanity I can handle.
Mathan, Todd wants a view on the ASX, the Australian Stock Exchange that runs all the platform. What do you think of ASX?
This is the one where you go, it's like the new crest of exchanges. You just know one day you wake up and they'll come up with something shocking and you get smashed. But, in saying that, it is so ugly right now. Nobody wants to touch it. That's the reason you want to look at it. I think ASX is a buy. It's a extremely ugly buy, but it's a buy because it's a defensive play. You're buying something that pays a relatively low yield, and it does quite well through the cycle in the context that even in a weak cycle, they have decent turnover. Even in a market crash, people sell a lot more than what they do buying. Okay. So they tend to do well. IPOs will be down in it, I'd assume, over the next 6 months, so that'd be a bit negative. But look, you buy this thing when it's cheap, and it's cheap.
Right. Below $70, that is a horrible chart, isn't it?
Oh yeah. Well, this is not sexy. This is not a growth machine. This is just a utility at the end of the day. But when you buy it cheap, you get the recovery cycle. So you're there to make money. You buy this below $70 and you hold it. It's boring. It's a dominant player. And when the market gets excited, this runs to 80.
Okay.
I always find it funny when this runs to 90, everyone gets excited. It's like, oh yeah, ASX is going to do something great. No, it's not. It does what it does, and it does it again and again. The big kicker for ASX is a bid coming out of London Stock Exchange or Singapore Exchange, because people in Europe want to get exposure to the Asian market. They want to get that Asian market exposure through Australia. So having that exchange allows them to do that. So I think inevitably there'll be a bid coming. That's the kicker, but you don't buy it for the kicker. So you now have the discount to buy it, and the free kick is there's a M&A potential.
Okay. Philip, ASX?
I think I'm on the show with the wrong Mathan. That's not the Mathan I work with. My apologies. I would have sworn you'd have picked that as a sell based on the momentum. I think it's a buy.
Buy as well.
There's so much doom and gloom in terms of the market at the moment. The stats recently put out by the ASX showed that everything looks terrible versus the prior corresponding period, volumes, trades, corporate activity. That's going to return to normal growth at some stage. It might be 12 months away, but geez, we're at near 3-year lows.
Yeah.
In an equity market, we know that works. We know there's demand for. People aren't going to put a lot into property at the moment. You would think interest rates are going up, so demand for bonds will go up. But as a genuine long-term investment, the ASX hasn't been this cheap for about 3 years. So I think for a genuine long-term, it's compelling value at this price. Yeah, I'd be a buy.
Okay.
And I was convinced Mathan would be a sell. So that's,
and if it gets back to the $90, even if you sell out of that, that's a 50% return for you.
Yeah,
so
absolutely.
At these levels. Okay. Our next stock, I didn't know much about. Damien wants a view, Philip, on Touch Ventures. It's basically a venture capital business that invests in tech companies that are associated with Afterpay or leverage off Afterpay's technology.
And initially, the share price spiked when it floated for all the excitement around Afterpay and buy now, pay laters, and it's come off a long way since then. Interestingly, in their recent trading update, they're quite cautious, the market. So this is a venture capital firm, private equity firm saying, we haven't got much to buy. They're holding a lot of cash and they're doing a share buyback.
Right.
That's not why you invest in venture capital. You want them to go and buy some assets, and from what we've just discussed, in the listed market, assets haven't been this cheap for 2 years.
So it's just been going a year, basically,
so
from 47 down to where it is now. Yeah.
So you don't want them to be doing a buyback, you want them to be investing in assets. So having said that, share price has fallen a long way. So for me, it's a hold. You would hold on at these levels. You don't want them to do a buyback. It'll support the price for a while. You want them to find some assets to buy and trend up back towards the 30-cent level. So it's too cheap to sell, but you hope in the next 6 months they talk more positively about the outlook and find some assets to buy, which is why people invested. Yeah.
Mathan, what do you think of Touch? In that sector, you've got Thorney as well, don't you? Thorney Investments, a similar type of business.
Yeah, well, Thorney owns some of this as well, and so a massive chunk of this is owned by Block. So so there's a lot of, I guess, interlinked play in this. Yeah. It's come back. It's hard to get excited by it. I mean, if you look at the whole asset management sector, I mean, we just had a bid for Perpetual, and you look at the share prices of all the people who are bidding and the people that are being targeted, they're all been falling for multi years. So it's not a great sector to play in. And Phil's right. I mean, if you're not going to invest when things look ugly, when are you going to invest? Yeah. You're supposed to be the insider. You're supposed to be the guy who's willing to take the risk for the return. I mean, I'm not buying an ETF here. So reality is you're paying for that fees. So yeah, I just don't get it. It's not big, and it doesn't excite me in the context that I'd expect them to be doing more than this in this market. This is the time for them to shine, and they're not shining. And again, the other one is, if you're a recent float and you've underperformed for the first 6 months, usually very bad sign. And this is very bad sign. So, you got to trust management, and I'm not trusting it at this point from what I've seen. So I'm staying out, wait for things to improve.
All right. Nick wants a view, Mathan, on Viva Leisure, the big health club operator. They own things like Club Line, Ladies Only, Hilt Republic, a whole bunch of fitness and boxing fitness facilities around the country.
Oh. Why?
Yeah.
Why? let me start by saying the guy that used to work with us, both Phil and me, whose wife did the design for the picture, he's the one who told me about this stock. And we were looking at this and trying to work out, why is it doing so well? I said, they're just buying gyms. And then Ben turned around to me and said, oh, look, they're going to build a data collection from all the gyms to have all these members and, build up a customer base. And I'm sitting there going, so what's the moat? There isn't one. So basically, one of the biggest growth industry is there's gyms everywhere.
Yeah, they're like coffee shops now.
Yeah, it's not much of a competitive advantage. There is no moat. The data collection is not going to deliver you much. I just don't get how this industry continues to do well. I think you need to be unique. You need to have something that's going to protect your business model, and I don't see it. The data collection I think it's a great story. Everyone wants to be a SaaS model. So I don't know how you become a SaaS model in a gym, but anyway, that aside, I think it's a tough one. I don't see the huge story in the recovery cycle. You're going to hold 20 odd stocks at most.
Right.
And you need to buy things that you can see how they're going to be at some point. I just can't see how this is going to be something at some point. I'll go out and back Ordinate or an Altium all day long. But when they say they're tech, this is not there.
Philip, Viva.
Mathan, do you even lift, bro? Do you even lift? No. Someone who lifts would never have that view. For me, this is a buy.
A buy?
It's a buy.
Right.
And it is about the data analytics. You may laugh, but people probably laughed at Kogan when Kogan started and said, hey, we're going to do data analytics and understand the customer. But people said, no, you will never compete with Amazon. And then Kogan did what they did. Right. So this is a data analytics business. I mean, there is apparently a gym on every corner for a reason. This is non-discretionary spend. A point of differentiation for these guys is they're not in the CBDs. Rents are very high in the CBD, so their nearest CBD location is Piedmont. These guys are out in the burbs. The rent's cheaper. So the gym equipment costs the same, staff costs about the same, but the rents are far less, which allows them to offer a more attractive price point. Their average customer pays $15 per week. By being in the suburbs with remotely working from home, that's where the customer is. So they spend a lot of time on money understanding the customer. So they actually ran us through their IT systems, their data collection systems about a week ago, where they measure everything they can, demographics, when people are going, what they're using. So there was an example where they gave that there was a gym in their network that was 70% females. Shouldn't be 70% females. It's a both sex gym. Normally that attracts the males. Why aren't the males coming? They realised that, well, we don't have enough 20 kilogram weights, so men generally want the heavier weights. So they put the heavier weights in. Back come the men. Everybody's happy. Right. They had another gym where they realised that, geez, our cardio equipment isn't being used. Why don't we switch out some of the treadmills and put some more weights? That brought back the members. So most gyms will have twice a year promotions. January, New Year's resolutions, then spring, 12 weeks till summer, get ready. They're constantly interacting with their members and they're picking up, gee, Mathan used to go every week. Now he's stopped. What's going on? Oh, he actually moved house. Why don't we tell him that there's a gym closer to his home? Why don't you switch the membership? Okay. So everybody's time poor. By keeping things simple, by making it easier for their customers to go, that's why they have 70% occupancy and they're the second largest chain in Australia. I actually think what they're doing is misunderstood, but they've got very good growth prospects because it is non-discretionary spend. So it's a buy from me.
Certainly a good case putting there. Mathan, are you willing to change your view after listening to that? No, okay. Will we get you in the gym?
Well, I think after I recover from the damage I've done playing cricket after 15 years, I think I might be able to go to the hospital more likely.
Okay, all right. Okay, our final stock, and I'll start with Philip on this one. Philip Elders, the big diversified agricultural.
Yeah, creates a lot of debate. This one, I think it's a buy. They've got a result out on November 14. I think conditions are quite strong in the Australian agricultural sector at the moment. We've had a bit of rain, we know that. That's been parts of the East Coast. The West Coast is largely okay. Farmers are making near record profits. They will continue to invest that back into their economy. Elders supplies a lot of their inputs. They should benefit this year and next year. It's another stock, a bit like Premier, where analysts like to call the peak and they'll deliver deliver 40% growth in EBIT this year, the market seems to think that that'll all of a sudden fall backwards next year. It's simply not going to happen. You know, you look at wheat prices, which are holding up pretty well because of what's happening on the other side of the world. Farmers are producing near record volumes. Cattle prices are holding up. I think the 12-month to 3-year outlook for this company is quite strong. And for those who want to argue an agricultural cycle, under the current management, their EBIT's grown by 30% per annum over the last 7 to 8 years. The worst year it went backwards by 1%. Okay. And during the last drought, it went up by 60%.
So it can manage through the cycles.
As we said earlier, good management doesn't sit there and let things happen to them. They make decisions.
Good point.
And
Mathan, you've been a bull on Elders for a while. You're still a bull?
Yeah, look, Phil and I've talked about Elders, I don't know how many years. And yeah, look, I think it's a great business. I think it's probably the best agri business because of the diversified model that it plays in. And in Australia, farmers are doing really well. I mean, talk to anyone in the regional space and you find out how strong the economy is. So I don't think they're going to be struggling. And Phil's right. Every analyst tries to pick the peak in, I think, agri sector. I think last year was supposed to be the peak, and the year before, and the year before, and the year before. So in reality, they've been wrong for a number of years. I'm pretty sure they're going to be wrong again. I don't think food prices are coming down anytime soon. And so in that context, I think, and regional, property values, regional farm values are extremely elevated. So I think the farmers are doing well, and Elders will benefit out of that. And the thematic still plays quite well. So, and management has a pretty good track record over the last number of years. So, there's everything to like about it.
All right, we might ring the bell on that comment. Phil's right from Mathan. Good way to end the bout. Let's recap our final 5 stocks. Ansell, a buy from Mathan, a hold from Phil. ASX, a buy from both, an ugly buy from Mathan. Philip has an attractive buy. Touch, a hold from Philip, a no from Mathan. Viva, a buy from Philip, a no from Mathan, and a buy from both in terms of Elders. So the bull during the show has come up with 8 buys and 2 holds, and the bear has come up with 4 buys, 2 of them ugly, 3 sells and a watch. So there we go. Ladies and gentlemen, it's great to have the bear, Mathan Somasundaram, and the bull, Philip Pepe from Shaw & Partners on the show. You be the judge. Go on Twitter. You score the bout to see who comes out with a win. There were no knockouts, I don't think. It will be a decision based on points. You let us know how they fared. Gentlemen, thanks for joining us.
Thank you.
Good to see you. A lot of fun. Good to see both of them. And something a bit different today. But and thank you to our graphic artist who was...
Christy Shanahan
for doing this, especially for the fellas. A lot of fun. If you've got any stocks you'd like to flick us an email, the call at ausbiz.com.au, or tweet us using the @AusbizTV handle. A reminder, all the stocks in the calls portfolio, ausbiz.co/portfolio. Coming up next, we've got Wicked Problems coming up just after 1 o'clock. So stick around. A lot happening on Ausbiz for the rest of the afternoon.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.